Calls because of persisting fears about jobs or the lack thereof. Volume, as we've heard, is light, but there is money to be made. So how do you do that? Let's ask Hary Rady. He's the CEO and Senior Portfolio Manager of, actually it's Rady, I'm sorry, Asset Management, and Mike Shinnick, Portfolio Manager of the Wasatch First Source Long Short Fund. Welcome, guys. Hary, sorry, my apologies.
No problem.
Let's start with you, if I could, Hary. You remain cautious going into 2011 because of a variety of factors. Inflation is one of them, and especially in light of the move that we see in gold. But overall, is the U.S. a better play, you think, in this new year, given what corporate America has managed to accomplish this year, than the emerging markets?
You know, we only invest domestically, so obviously, you know, for me, the answer is yes. You know, we think 2011 is going to be the year of M&A. And I think people are expecting M&A to pick up, but I don't think that they're adequately discounting the level of M&A that we think is going to occur. We think there's going to be an absolute M&A explosion. We think that larger companies have cleaned up their balance sheet and are sitting on an enormous amount of cash, and that it will be difficult to grow to meet the multiples, the PE multiples that currently are on these stocks.
Isn't this also, though, Hary, because a lot of private equity firms were unable to bring those firms that they took under their wing to market in this past year? It was just too tough, and they're chomping at the bit for 2011 to take these companies public again.
Well, I think that's one of many reasons why M&A is going to be enormous. And we think that the sectors to focus on are going to be tech, obviously, energy, defense, and healthcare. So we think the way to play it is to own more mid-cap oriented companies, companies that have, you know, perhaps strong market positions, strong product portfolios, IP, things that an acquirer would want.
Mike, how do you play it, and do you agree? Because, I mean, is there a pair trade you can get involved in? Because if you're in the name and you get acquired, it's great, you get that premium, but that's sort of kind of like a lottery.
Well, I mean, look, we don't own any stocks for the sole reason that it's going to get acquired. But if it looks attractive to us, it likely looks attractive to a potential acquirer. And I'll give you an example. The defense industry, you know, everybody knows that defense spending is getting cut significantly. Well, these large defense companies are going to be looking for growth. So we own a company called Fleur Systems. Fleur Systems is the company that allows the military to say, we own the night. And the other big defense companies just simply don't have that technology.
Let me turn. Excuse me for interrupting, Hary. Mike, could you address the same issue that Brian just put forward?
I meant to ask Mike.
That's okay.
I know you did. I
ahead.
appreciate it. I was trying to be polite.
I'm sorry.
And you were. No, it's okay. Go ahead, Mike.
So I would share the same thoughts that companies that have good balance sheets are good companies to own. We look at the capital allocation opportunities in front of them and prefer those companies in energy, in tech. There are some healthcare that have those very wonderful cash-rich balance sheets. In terms of consolidation, your question kind of was premised on long and short. In general, companies that we're long, we think are good businesses, irrespective of what happens with M&A, though it's a nice kicker if it does happen. So, for instance, a company, Blue Coat Systems, that we own, struggled a little bit in terms of their European sales, brought in a new CEO this fall. They didn't really participate with many of these other cloud stocks, but they're in the right place with wide area network optimization, web security, et cetera. Certainly very digestible with a $1.5 billion market cap.
Mike, take a listen to a soundbite that we got this morning from one of our guests, Mr. Jordan, about the imbalance that is starting to occur in global markets and why he favors the United States. And then if you give us your reaction to that.
Sure.
2011 is going to be the year for the United States stock market. Not emerging markets, maybe not even Europe. I think the U.S. stock market is going to be the big winner. I think you're already seeing people start to position themselves that way. You know, the Chinese market's weak. This is the first time in 10 years, if you take a look at the charts, first time in 10 years the S&P is making higher highs and the Brazilian market is not. Now, I think that's a sign.
All right, Mike, you first, and then Hary, if you would respond to the S&P aspect of it. But Mike, do you agree that perhaps if you are in emerging markets, it would be time perhaps to take some profits and reallocate here to the U.S.?
There's a potential for that. I think the big question for all of the world markets is around currencies. And that's a deeper issue. But to the extent that the U.S. dollar is relatively strong versus, say, the euro and the yen, both of which have a lot of domestic problems in those countries with debt, relatively, even though we have our own troubles, the U.S. dollar could do better, therefore setting it up.
Just very quickly, Hary, go ahead.
And two is the level of valuation, particularly the mega cap. And there I defer to somebody like a Jeremy Grantham, who's been on this for a couple of years. But you look at the J&Js and Medtronics and Intels and Ciscos and Visas and Microsofts, and you've got great companies that you can get for 10, 11, 12 times earnings. It's very inexpensive.
We got to go, guys. We wish we had more time. We appreciate Hary and Mike for your insight. Just when people were getting optimistic about housing.
I know. There have been some